What does it really take to build something extraordinary? Behind every thriving business is a powerful mix of grit, creativity, risk, and the relentless drive to keep going when others would stop. Welcome to the Next Venture Alliance Show, the podcast where entrepreneurs, innovators, and trusted advisors come together to uncover the stories and strategies behind remarkable ventures. With your host, Oliver Kotelnikov. Whether you're building, buying, scaling, or selling, this is your space to learn, get inspired, and prepare for your next venture.
Hello, everyone, and welcome to the Next Venture Alliance Show. I'm your host, Oliver Kotelnikov, and I'm an entrepreneur, a storyteller, a mergers and acquisitions advisor, and a business and commercial real estate broker. On the show, we sit down with founders, business owners, industry leaders, and the trusted advisors who support them. And together we explore both strategic and human sides of entrepreneurship. Our guest today is Christopher Thom, CPA and owner of Evergreen Accounting. Chris and his team specialize in tax preparation, strategic tax planning, and advisory services for individuals and business owners. Their work goes well beyond filing tax returns, helping clients make informed financial decisions year-round through proactive planning, retirement strategies, business tax optimization, and guidance on complex financial and tax matters. Chris earned his undergraduate degree from University of Colorado and graduated magna cum laude with a master's in accounting from the University of Notre Dame. His professional experience includes leadership roles with such well-known firms as PACCAR, Moss Adams, and HKP Advisors. He's also a veteran of the United States Army, and in addition to his work in accounting and tax planning, Chris has spent years advising business owners through mergers, acquisitions, succession planning, and ownership transitions. He's seen firsthand what separates smooth transactions from difficult ones and what business owners can do years in advance to improve their outcomes. So today we'll be discussing the role of a CPA in the sale of a business, common deal pitfalls, tax planning opportunities, valuation expectations, and why successful exits often come down to two things: planning and preparation, and working with a qualified team of advisors to execute on the exit strategy. Chris, great to have you here. Welcome to the show.
Thank you so much. It's nice to be involved and glad to give a little bit of background on me and help out in any way I can.
Yeah, so I mean, you've had you're kind of a man of many interests and have had having an interesting background and biography. I mean, tell us how you got to want to be a CPA and start Evergreen Accounting, and what led us to this conversation here.
Yeah, sure. It certainly was not linear. I grew up in Seattle, in the Seattle area, and out of high school, didn't really know what I wanted to do, and so joined the Army in hopes to sort of grow up quick, and was stationed there in Germany for most of my tour. Left the Army after 4 years, became a government contractor, and worked as a mechanic on M1A1 Abrams tanks, and worked on Humvees and 5 tons and 10-ton wreckers and stuff as a diesel mechanic in Fort Carson, Colorado Springs, where I started going to night school. And eventually night school leads to a 4-year college, and you end up with a degree. I chose accounting. I'm interested in numbers. I'm interested in puzzles, but ultimately really just wanted to help. What I discovered even later was really loved helping the people that don't enjoy doing certain things. And so nobody loves taxes, and I found myself helping to solve tax issues and complexities and synthesize it down to a conversation that can be understandable. So got a degree in accounting, and I wasn't going to go to get my master's degree originally. I had a professor that was great and talked me into going to grad school. got into Notre Dame. I'm not still kind of quite sure how, but got into Notre Dame to get a master's degree, and then started my career after Notre Dame at Deloitte Tax in Seattle, back kind of coming back home from South Bend, Indiana. So I was at Deloitte for about 4 years, working on all kinds of transactions and 10K and stuff for publicly traded companies, very high net worth individuals, and so on. And got burnt out pretty quick. After that fourth year, it was like, time to kind of rebalance work and life. And so went to PACCAR as in Bellevue, Washington, as they're one of their assistant tax managers, and did that for a couple of years. That was like the opposite spectrum. Whereas Deloitte is very robust and dynamic, and nothing against PACCAR. It was a wonderful experience, but at the end of the day, it ended up being um, kind of routine, day in and day out, 8 to 5, and same sort of accruals and issues and stuff that you were tackling from day to day. And I just found myself wanting more, and also wanting to help more people, kind of one to one. And so ended up over at Moss Adams, um, doing just that, working small business and being a small business advisor, and working with families and such. And then I got into M&A through my experience at Moss Adams, and I spent a great deal of time working with both buyers and sellers, learning what private equity acquisitions were. Was involved with a company that
Hmm.
bought themselves back from their private equity. Knew they We helped them sell the business to the private equity, and then we were still working with them. And then it didn't go well. And so we actually helped them buy themselves back from that private equity. That was
Hmm.
fascinating, but a wonderful group and set of owners. And I still continue them today. And we're about to go potentially into another transaction where they're looking to retire. And they've owned the business for a good 15 years at this point, and they'll be looking to sell here in the next probably 24 to 18 months, or 18 to 24 months. They'll be looking to sell their
Hmm.
so, which is really so. Then I started Evergreen Accounting. I spent a little bit of time at a company called HKP as a partner, about 4.5 years, and then I thought, I can do this in a more advanced, innovative way, kind of bring a new light to the accounting profession, in a hope to be more streamlined and more in depth, or have a in depth relationship with my clients. And so I thought, I can do this on my own as a new firm. And so I created Evergreen Accounting about 6 months ago, 7 months ago at this point, to do just that. So, and it's going really well.
Awesome. Well, thanks for the overview. It looks like things have kind of come full circle, and then you're off to a pretty new, exciting chapter. And if I know you crossed paths with IBA, which is how we met, and I think we share similar philosophy, and maybe see the same thing from clients and business owners, in that they there's a tendency to spend years, sometimes decades, building the business, starting the business, building the business, and giving it all this time and energy. And then when it comes time to exit, it can kind of get treated as an afterthought, and say, well, now we're done. We're just gonna list in the spring, and and maybe try to rush through that process. Whereas we try to encourage business owners to look at the process of sale as kind of a comprehensive process, and a you know it's one part of a larger, make it a plan, one part of a larger financial plan. Include the sale of the business in your overall sort of scheme of things. um, and so, to me, that's the difference between a sale, which is just transactional. You're selling a car, selling a boat, maybe you're selling a piece of property. Let me just sell the business, versus a transition of a business, which is what an asset like this requires. In your mind, what differentiates, a simple sale of a business from succession planning and, exit strategy?
There's so much, I think, difference in really it's not maybe not necessarily about the numbers, which we can get into and we can talk numbers, and there's no emotion in numbers. It's just the number. When you're talking about a
Hmm.
sale of a business, it really has to, it's more to do with that business to the seller. That's their baby in a way, right? They've built a life around it and they've put time, sweat, and energy, tears, successes, and all of that emotion in history comes along with it. And so when a seller is selling that, and there's also interpersonal relationships with the team that they've have in the company. And so you want to hand that off and trust that the buyer is going to do right by the company, by its customers, by its employees. And you don't, as a seller, I would imagine, um, you don't have that level of trust yet. And so to the buyer, it's the number, like how much do we have to pay for this company? But to the seller, it's their everything. And
Hmm.
so it's more than
And it, yeah, and and there can be that gap where, the seller, somebody's selling their life's work in essence, or transitioning it and trying to put it in good hands. And sometimes on the other side, it can be met with numbers, you know, sort of a pragmatic approach, and really an investment and a money making widget, which can derail, as you know, negotiations pretty quickly. And we need to build trust before we start talking about the numbers. I don't think any seller is, denying the fact that we need to discuss the numbers objectively. But
Mhm.
there is a trust factor here that's probably larger than in, just about any other type of transaction or transition.
Yeah, I think the hope for a seller is to sell to a strategic buyer, so somebody in their industry that wants to continue to operate and keep enough capital in the business for its own internal growth and to support the employees, as compared to like a private equity or a venture capital purchaser that, is looking to have a turn on their investment and to realize appreciation and return on asset, return on investment to their investors. So there's a different motivation and therefore a different level of trust between the seller and the buyer, in my opinion. So it's
What is
it
the
can be
role of an accountant or a CPA? Oh, sorry.
yeah, no worries. The role
Yeah,
of a
what is the
CPA.
role of an accountant or a CPA in a transaction? Yeah. I know we're talking about a
Mhm,
team and building a transactional team, and
mhm.
they're different. You can have the broker and an attorney, and there's, lenders and wealth advisors, and uh, I- what what does a CPA do in a transaction?
Yeah, so I think that the seller needs, from a seller's point of view, they're relying on their CPA to help sort of translate the deal into what am I getting? What's the number after tax? And then to help guide them and guide the broker and guide the legal department or the lawyer along with what are the numbers, what are the risks behind the numbers so that you can help coach on really what are they looking at as far as the after tax proceeds so they know what they're going to be living on after the sale. So understanding them, translating, helping to translate the deal into what it is they're selling, how is it going to be taxed, how much am I going to keep? If there are surprises, are there any things in here that, methods of accounting, are there anything that we should do now to prepare the company to sell? And so I think that it really, the earlier a CPA can get involved with the sale, the better. A seller can even have their current, CPA firm working the deal, but if that CPA is essentially a tax preparer and not necessarily a tax consultant, with M&A experience, they may miss things, or not know that, oh, well, we can set you up from a tax methods position so that we're able to defer tax, minimize tax, look at the jurisdictions, look at some of the filing positions to make sure that everything is safe, so that we're not reducing or diminishing value at the sale. So I think that the CPA's role is multifold, but it really comes down to helping structure, plan, and then almost be the middle person between legal and the broker, so that because we sort of are the pivotal point or pivotal contact between both and to the um to the seller.
Hmm. Hmm. Yeah, and you touched on an interesting topic there. It's the tendency is always to focus on the money coming in, right? What's the number? Again, we're back to the numbers. What's the purchase price? What's the number that I'm getting? But the proceeds, uh, after tax, are can put a dent in that. So it's kind of a penny saved is a penny earned. What are some of the things that a seller may not be thinking of that will impact um, their walking away number?
Structure, business structure, is one component that we often see having pre-selling reorganizations and working with legal to put together a structure that would allow the sale of the, say, company's operations, um, to um, help minimize or defer tax. That certainly helps, and that can take time. Um, the other piece too is, sellers oftentimes may be, say, charitably motivated. I had a client a few years ago, that tithe 10% of all of their income, and we were able to help, knowing ahead of time that they were ready to sell. We were able to help structure an ability for them to tithe their S corporation stock prior to the sale closing, so that they were able to get the value of the sale on that stock as a charitable donation, without having to pick up capital gain in their taxes, for the sale of that portion of their stock. So, it saved them, well over $1 million, based on the ultimate sale price, but they'd saved them well over $1 million in capital gains, results
Mhm.
of that charitable
That's
donation.
a, I mean, that's a tangible number, right? You saved seven figures. It didn't come from the buyer. It came from tax treatment,
Correct. Yeah, and being
right?
knowledgeable ahead of time. I'm working with a seller now, and they've had years of losses, and they've got, everything passes through because it's an S corp. Everything passes through to them, but they have years of accumulated loss carry forwards on their personal returns, and so helping navigate through structure, and purchase price allocation, which is something we haven't talked about yet, but through that, helping them understand what the taxes are and if there's any planning opportunities, prior to them, their exit, paying off debt, things like
Hmm.
that. Getting into working capital, and that helps with purchase price allocation. There are lots of little concepts, that can help on that end.
It and again, it all comes down to planning, and we can get into terminology here shortly, and some key concepts. But some of these things that you're discussing, they're difficult to problem solve under the pressures of a live transaction and in the deal room, right? When the seller is introduced to some of these advanced tax concepts, down the line, when they're trying to negotiate a purchase and sale agreement and learning about this in the process, that can be a lot to handle.
Mhm.
There is really no need to, I mean, all of that can be done in advance, right? I mean, we don't even need to have the business listed. Um, oftentimes we work with sellers. We start with an evaluation, which is a detailed document outlining the fair market value of the business. Based on that document, even if it's in a range, you could model tax outcomes prior to listing the business, helping the seller based on that evaluation model their exit proceeds, their retirement investments, etc. Um, and again, all of that is much better accomplished, without the pressures of a live transaction.
You're absolutely right. And in on top of that, when you're in the middle of the transaction, there's a lot of hurry up and wait. But if you're ahead of time, you can adjust and you can plan for it. You can set expectations. And then, then you as a advisor, then, it really helps because you're able to meet those expectations. No seller likes a surprise at the last second that, hey, if we would have structured this differently, you would have saved a couple 100,000, a meaningful number,
Mhm.
of money. So, um, there's certainly opportunity to get in front of things when you're not in the middle of a transaction, when the seller you know, wants to make sure that they have everything checked off and that everything's there, but a buyer wants to get the keys to the car. And so there's a lot of, hurry up and, let's get this thing closed so that we can take over. The seller wants to make sure they've got all of their ducks in a row so that they're not leaving money on the table.
Yeah, and I would say tax planning especially is one of those items that really benefits from early stage planning. Because if you don't understand something, you have the time to um, to ask for advice and learn about it and make sure that you do understand it without there being a deadline for X, Y, and Z, which a transaction is always a series of deadlines, right? That sometimes they can be extended, but it creates pressure. So, um, how early should a CPA be involved? How early should a business owner be talking to their CPA if the thought of succession planning and transition and selling the business has entered their mind? When's a good time to talk to your CPA?
The standard is right as early as possible, but realistically, a good CPA and a good advisor should be having that conversation and checking in annually. Um, they should be getting in front of their
No worries.
client and having that as they check in throughout the year, or at least, like I said, at least annually to every year and a half. If it's a new relationship, I would say that, with not less than a year, you want to be in the middle of the transaction, or saying, hey, how do we do? Like, we close, how do we do? Like, you don't want to be having it then. Like, so I would say 12 months to 18 months prior to a transaction, if your CPA hasn't brought it up and asked you what your planned exit is, then, if you're starting to contemplate an exit, a year to a year and a half prior to, so that you have one planning period to adjust, if you can, structure and methods of accounting. You can adjust for that one filing period before you actually have that potential exit, is really helpful. If you can get like a method change, for example, if you're, an accrual method of accounting, and it would be better for you to be cash method, or vice versa, having 1 year behind you to say, I've made that transition, and now I'm filing under this method. you know, Oftentimes a buyer wants consistency. And so in a sale, so a buyer is going to say, through their deal and the documents, they're going to say, okay, you're going to treat your taxes and you're going to treat your accounting in a consistent method that, we put the LOI to you, under. So, um, that could
Mhm.
change the economics of the deal if you're not able to do company level planning, because now you're in the middle of the transaction. So,
Yeah, and some of those changes, again, we're back to time, and then planning and preparation can take a long time to implement and to take effect, to be of benefit, right? Sometimes we can come to like you said, we can come to understand a deal term or a concept, but all it does is create frustration if it says, well, I'm glad you understand it, but if you understood it 2 years ago and did something about it, that would have actually saved you money. For now, we got to move on, right? That's a frustrating bit of news to receive. I mean, it almost doesn't help you at that point.
Absolutely. The best situation is I had a several years ago, I had a very large doctor practice with multiple offices. They came to our firm and said, "We're looking at selling 100-year-old doctor's practice. We're looking at selling, and we think we're going to close in 2 years. And by the way, we have three possible buyers." And so they looked at our tax team and said, "Can you help model? Here's three LOIs." It was like the best graduate school level like project ever. It was, here are three buyers. Here's three LOIs with three different terms under the LOI. Can you please let us know what each of our owners, we're talking about 100 owners, what each of our owners can expect to receive on their final paychecks and on the final sale of the company? And to be able to take that, model that for them, come back to them with, buyers one, two, and three. And by the way, we're also going to look at some methods, and we're going to look at slowing down depreciation so there's less recapture. These little things, we were able to carry that out all the way through and help them with the sale of the company. And then filing final tax returns, we filed their final bonus W-2s, and then all the way through an IRS examination, and with fortunately no adjustment by the IRS agent that reviewed that transaction. And so I look at that as like, that is the ultimate success from an accountant's perspective. That's like, to be able to go from an evaluation of a buyer from a sales point of view, and then carry that all the way through to 2.5, 3 years later to say, okay, we've concluded that final audit from the IRS, and there's been no adjustment on a deal that was about $125 million. I mean, it was significant, and it
Hmm.
was meaningful to each of those owners. And to be able to take that, and see sort of the resolution, the completion of that all the way through to the end was really remarkable.
Hmm. Yeah, and you're right that is a perfect case study that illustrates exactly what we're talking about here. Um, but one thing I'd like to touch on, and something I do, as part of this podcast, is education, and education in terms of, we assume that everybody knows what terms mean and everybody has the same understanding of them, but so often even professionals don't, or they're coming, they're kind of wearing a different hat, and so in terms of accounting, um, you mentioned tax allocation, and I'll just ask him in a very rudimentary way, what is tax allocation and why is it important?
Yeah, tax allocation is a concept where you're taking the purchase price of the company, that end final price, and you're carving it up into what the buyer actually bought. So if I looked at it like in terms of, if I go in and if I go to, Nordstrom Rack and I buy like clothing, I bought shirts, I bought shoes, I bought pants. Purchase price allocation is similar. I bought accounts receivable. What are my
Hmm.
assets, right? I bought accounts receivable. I bought some trucks. I bought computers and equipment. I might have taken over their leasehold improvements. There's various things on the seller's balance sheet that I have to carve up, because I might have paid $10 million for the business, but $3 million of that was my purchase of accounts receivable, which leaves $7 million left to go. Okay, well, what else did I buy? I bought trucks and forklifts and manufacturing equipment. If I'm buying a restaurant, I bought kitchen equipment. So I look at all of that and I go, what is the value of the items that I purchased? Inventory is another one that, and a buyer is going to come in and say, well, depends on the motivation of the buyer, but the buyer may come in and say, we want to value inventory at the price that you have, and the seller's going, well, but I intended to sell this for more than I paid for it, and I put my inventory in my books at cost. A seller or buyers might say, well, we want to show that we're really profitable from the get because we're a PE firm, and so we want to have ratios that show that we're really profitable and that the return on our purchase it was great out of the gate. So you have a differently motivated buyer than somebody going, I want to.
But explain what the difference is behind, like what motivates them differently. What's the difference between $100,000, $1 million, or $500,000 of goodwill versus $1 million of equipment? Why does that matter to me as
the
seller?
Seller is if the seller sells their inventory at a higher value than their cost, then that's ordinary income at ordinary income rates. So anything allocated to their ordinary income bucket, it may have a higher tax bracket than buying goodwill or selling goodwill, because goodwill has oftentimes long-term capital gain rates, and long-term capital gain rates can be 20% at the high bracket currently. You can get into whether or not there's other taxes on that, like net investment income tax, but 20% flat is the long-term capital gain rates. Now, we live in interesting times in Washington State. So Washington State has its own capital gain on long-term capital gains. So, they may be paying 20% at the federal level, but oh boy, there's potentially a 9.9% rate. So maybe it is beneficial now in new times to sell inventory at a higher profit at 37% or whatever because of qualified business income deductions and stuff. I'll just say, like, call your CPA because they're going to run the numbers and they're going to say, well, what's more beneficial? You know what? It's actually going to be more strategic and beneficial from a tax perspective to have higher profit in your inventory, because the net impact of selling inventory could be 30% after the qualified business deduction versus a, call it 30 point or whatever, I guess it would be 29.9%, what have you, if you're adding carry forwards and stuff like that in there. So no deal is one size fits all, but those motivations, the CPA is going to be able to carve out and say it's going to be more beneficial, whether it's long-term capital gains or ordinary income bucket.
Because those buckets where we put the purchase price dollars are all taxed differently, right? If we have $10 million and putting 2.5 million in each of the four buckets is going to result a different net proceeds than putting 75 in one and 25 in another.
Absolutely. Yep. Right? Yep. And you don't ever know, there's no deal that's one size fits all. And so, and this year's answer is going to very well be different than last year's answer or next year's answer. So just because of tax carry forwards, basis adjustments, there's, different jurisdictions, maybe you were never in California and now you are. So, there's just different things that you have to think about when it comes to, the sale of a company. So, and we haven't, then there's also, that's a purchase price allocation is a asset sale concept. But if you're selling the company's equity, if you're an S Corp or a C corporation, you're selling the company's stock, then purchase price allocation is sort of not even relevant because you're just selling stock at the basic lay it at. So it's not going to even be relevant from that aspect.
And we can touch on the asset versus stock sale here shortly, but one other thing in allocation that can impact things in deal environments is kind of the legislative environment. What tax laws are being passed? Like, on tax allocation, as of late, buyers are just clamoring to allocate things to allocate as much as possible to equipment because of certain accelerated depreciation benefits, right? That's the bucket that allows them to And that's it's been contentious lately. We need to allocate a fair market value to equipment and vehicles, but a buyer in this tax environment wants to put more in that bucket because they get a write-off. So knowing that, knowing somebody's motivations, okay, and the intent behind the ask, somebody saying, look, we want to put this outside, you want to put this on inventory, we want to put it on vehicles, furniture, fixtures, equipment, and vehicles. Why is that? And oftentimes it's dictated by
Bonus
you
application.
know tax laws.
Absolutely. And buyers can get, they can forget that if you're buying equipment, you got to remember that, in Washington, we're, often 10, almost 11% sales tax. So if I'm buying equipment, I got to
Yeah.
pay sales tax to Washington State on that. So does it make sense as a buyer to, add 10% on the cost? That's not going to the seller. It's going up to, Washington for sales tax. So all of those factors get factored in, and structuring can help. Often it can help a buyer if a seller is selling things that are legally an equity sale, but for tax purposes a stock sale or an asset sale. Then Washington may say, well, this is a purchase of an intangible, and so it's not subject to sales tax. So there's benefits to
Okay.
structuring not just the seller, but there's benefits to structuring the company so that it impacts the reduced tax from a buyer's perspective to save on sales tax and still get the benefit of step up in basis and purchase price of equipment and stuff without worrying about sales tax.
I mean, so both sides are doing the tax math in addition to, again, the tendency is to focus on the purchase price and the dollars being spent and the versus dollars coming in. But what happens to them afterwards, right? They both have to report that sale identically to the IRS, and that they both have to agree to that tax
They do.
allocation schedule. How will those numbers be taxed, depreciated, et cetera, is a first order
Yeah,
consideration.
and in a nutshell, right, a seller generally, up until Washington introduced capital gains tax, the seller would generally want to sell its equity. They want to sell their stock, whereas a buyer wants to buy assets, so they get a step up in basis and be able to deduct depreciation and stuff like that and including goodwill. If it's a stock sale, a seller, they're getting capital gain treatment, but the buyer doesn't get to depreciate any of the goodwill or intangibles. But if it's an asset sale, then whatever goodwill is allocated in the deal, they get to take at least a 15-year recovery on their allocation to intellectual property.
So we're on to the kind of that next topic of asset versus stock sale, which is another one that comes up all the time, right? And then sometimes doesn't get discussed early enough or often enough, and is then introduced into deals by parties that haven't consulted their tax professionals, saying, we'd like to change the deal structure because we've learned X, Y, and Z. That information was probably available the whole time if they wanted to do some early digging. But talk about the difference between stock and asset sales. What is the main difference between those two deal structures?
The key difference is the difference between capital gains and ordinary income through allocation of assets, the purchase price to assets. So that's that piece alone is the key significant difference. You might say that the stock transaction or equity transaction um, has some legal baggage to it. If a buyer is buying the company's equity, they're buying all of the legal issues. So diligence can be delayed or
Which gently shifts it to the legal, right? You have the whole tax issue here, and then there's the liability issue between stock and asset sale, but they're sort of different, but both equally
yeah,
important.
I mean, yeah, exactly. A stock deal, the buyer is buying all of the history. And so whatever statutes are behind it, they're adopting. And so reps and warranties and all of these things on the legal side become applicable. The benefit of it, though, is that things like contracts and EIN, like numbers and stuff like that. And I deal a lot with the aerospace industry, and the FAA can take aerospace manufacturers and say, this, they want to have an existing company with their filers. And so, if you're dealing in aerospace manufacturing, retention of the EIN is significant. And
What is define EIN
EIN is
and
your
what is
employment
that?
identification number. So it's your employer, number. It's the social security number for the business, essentially.
Good way to put
Yeah.
it. So so in this case, in the stock sale, if they inherit the EIN, everything that's attached to it, lucrative contracts, talent, employees, agreements with vendors, all of those sorts of things transfer with that EIN number. If you're doing an asset sale, the company is essentially buying the assets of the company, but not the entity and everything that came with it. So they would have to restart all those.
Yeah, exactly. Exactly. So
Wow.
it can be, that can be a good thing. But the benefit to a buyer is that step up in basis. And there are hybrid deals that allow for, restructuring so that you can set it up that way. So it's treated like an asset sale, but not for legal purposes. It's still an equity deal, but vanilla. When you're buying assets, I start up my own new company with my own new EIN, and I go to the seller and I say, I'm going to buy your equipment, and I'm going to buy your workforce, and I'm going to buy your AR, and so on. But you know, each of those things have a price that I'm paying for it, um, and then whatever's left is goodwill.
Talk about basis. So what is basis and depreciation, and why is that
Yeah,
important?
basis in a nutshell is the after-tax dollars that you have in the business that you can recover when you're figuring out your gain. So if I look at it like, if I bought my house for 500,000 and I sell my house for 600,000, my basis is 500,000 because that's what I paid for it. And then my profit is the difference between my sales price and what I bought the company or bought.
If none of it has been
Correct.
depreciated, right? For assuming that it just
Yep.
stayed.
Exactly. If I depreciate my purchase, then I'm reducing my basis. I'm reducing the purchase price because I'm able to then benefit from the deduction of the costs, as I'm recognizing depreciation over the period of time that's been allocated to that asset. So if it's a if it's a commercial building, I have 39 years that I can depreciate my building for. Um, and so whatever's left, if I'm say 20 years into that building, I've got half of my basis remaining. If I bought it for, essentially a million, then I've got $500,000 left that I can recover when I sell it. But the difference between what I originally paid for it and what I have left to recover, that gets recouped or recaptured. It fills the bucket back up to my original purchase price at, essentially, we'll say, ordinary rates. It's real estate's a little different, but essentially you have to recoup that because you took a deduction for it over the years. I have to fill the bucket back up at the tax rate, the ordinary tax rate that I benefited from it, before I start recognizing capital gains on top of that.
So in a deal, setting aside some advanced deal structures that sort of shift the deal from one to the other for tax purposes. Um, uh, the benefit of an asset sale is that the buyer buys the assets, gets the new basis, essentially what they paid for it again, and then gets to take that write off over 10 years or a shorter depreciation schedule, whatever the law
Yeah,
allows.
well, and the buyer right now in this legal regime, as you mentioned earlier, they get to take an immediate recovery of all of the equipments, everything up until and including potentially including the lethal improvements. They just get to write it off. So If I buy a business and all of my purchase price is allocated to the equipment, I might have paid $2 million for my equipment, but the buyer gets to take that $2 million and just expense it, essentially.
Kind of like an immediate 179. You just write it off.
Exactly. So
Yeah. So that's I mean, so there's great motivation there to allocate the purchase price to areas that create the most tax benefit, and knowing, what the law allows at the time of the transaction.
Yep, that's exactly right.
Yeah. So some other concepts that are sort of in and out of deals a lot and become prevalent and sometimes contentious: working capital. My experience has been that working capital started somewhere in the middle market and above, a few years ago, or has always been there, and then has slowly trickled down to smaller and smaller deals where it's sort of borderline not applicable or not applicable at all sometimes. But what is working capital, and why is it part of a conversation when a company is being bought and sold?
Yeah, working capital is confusing even for people that do transactions all the time, because it's defined as a part of the deal as what it is. And so deal number one is going to have a different concept of working capital than deal number two. Ultimately, I think the textbook definition of working capital is the amount of fuel in the tank of the company that you bought before it's asked, because you're buying assets, you're buying an asset is something that's going to generate a future benefit. And so, you want as a buyer to know how quickly that asset you're buying is going to turn itself into a benefit, into cash. And so it's the fuel in the tank that will allow the company to operate, because the payables, the debts and bills and purchases of inventory are happening, and you're buying the business, whether it's an asset sale or a stock sale, you're buying a company that's operating. And so now you can just shut everything off and say, okay, we're going to collect all of our cash and we're going to pay all of our bills, and then we're going to start fresh.
Take all our receivables.
Yeah. And so you want to make sure that you have enough fuel in the tank to allow the company to operate and not have to, as a buyer, not have to inject new cash into the company so that it can pay its own obligations. You want the company you just bought to be able to turn its inventory and receivables, convert that into cash so that you can pay your utility bill and your employees and the various payroll taxes and the rent, everything else that you bought. So I think the textbook definition is like current assets that are current assets less current liabilities is the working capital. And essentially the deal says that I put a letter of intent out there, an LOI. I put that out there to the seller, and I say, I intend to buy your business for an amount. But it's assumed that within that amount is enough capital in the company, enough cash and current assets to cover its liabilities until the next dollar after that amount, whatever that is, usually called the peg or the target, is to say that the next dollar is now earned on the assets that I bought as the buyer. And so it's contentious because so many times the smaller market, they don't keep their books on what we call in accounting accrual method. They don't keep it on accrual, where you're recognizing receivables and payables and debt on lease obligation and right to use assets. You don't think about those concepts as a small business. Usually you're cash and disbursements accounting. And so when you get the cash, that's when you recognize income. And when you pay the bill, that's when you recognize the expense. But the buyer is coming in and going, well, but we have purchase orders on the books. We know that we're selling this much, and so we need to recognize that maybe as a receivable. But we also know that the utility bill is due from last month, and so that's a payable. And they need to know what that number is. And so because it's not tracked, it can be really contentious on what the target peg is, and then it can be contentious on what those numbers are on the day, because everything's estimated, the transaction
Mm-hmm.
using, older balance sheets and income statements. Everything's sort of estimated, and then there's a closing date. And so then that gets sort of locked down to say, like, here's what the number is. I always think of it, and then I'll stop talking about it. I always think about it as if
No.
I'm a buyer and I'm going out to purchase, a car, there's some assumptions I've made, and I've gone out and I've looked at, Kelly Blue Book or whatever. I'm like, okay, like I know that, so I assume that I'm buying a motor and seats and a steering wheel and tires. I am assuming that, but those are the tangible assets. I'm assuming that the tires are inflated. I'm assuming that if I'm buying a car, that there's wiper fluid and that there's transmission fluid and that there's a full fuel tank. But if my seller that I bought this from delivered the car and the tires are flat, and the fuel tank that we agreed to, like, hey, I agree that I'm buying this car and it's gonna have a full fuel tank, and it comes to me empty, then I have to go put my own money in to go to the gas station and fill the fuel tank. And so I'm going to adjust my purchase price because I assumed this. You kind of represented that you were going to sell me it with full fuel tank, and I don't have to inject my own money to go fill it. Um, and and so I'm going to adjust the purchase price to that peg, because the delivery of that asset to me as the buyer is different than my assumed or my agreed upon understanding.
Is with a rental car analogy and the gas gauge when they say you're going to work as a sort of a true up mechanism to say you're going to, we're going to give you this much gas in this car when you rent it, and you need to bring it back with the same amount of gas in essence.
It's I think it's good on the rental car analogy. The only caveat is that if you receive the rental car with half a tank and that's what you're agreeing to bring it back on, but then me, as I can't guess how much fuel I'm going to have to target or peg that half a tank, I might have filled it and brought it back with a full tank of gas. Oftentimes the rental car company is not going to go, oh, you filled it and we gave it to you with half a tank. We're
No.
going to pay you the
Yeah.
difference. In a working capital analogy or metaphor, that it works the other direction. If a seller sells a company with a peg that's set, but the reality is that there was more receivable and there was more cash on hand at the date of the acquisition than the peg, the buyer gets an adjustment in their favor. The buyer gets to take a little more back. And so, it worked
The
both ways. Or
seller.
yeah, sorry, the seller gets more back after the adjustment. So it works really well because it's fair to both sides. So
Hmm.
it works out.
Yeah, and it's no, and it's and we're talking about it because it seems really simple, but that in every deal, uh, everybody interprets it. People understand what it means, but it's interpreted differently, and sometimes depends on which side of the transaction the advisors are on. They're kind of wearing that hat, and as they should, being fiercely protective of their clients. Um, but it's really, it's how much money needs to stay in the business to keep it operating at the profitability and kind of operational stability that we've agreed to, in the evaluation and the contracts. How much money needs to stay in it without bringing additional capital into it on top of the purchase price? Is that sort of the philosophical view on it? Is that a buyer deserves that to be included in the purchase?
Yeah, I think that if that's what the agreement has been, that built on the LOI, is that they've agreed to have this amount left in the company so that it can run on its own fuel, without the buyer putting more money in. Where I see the biggest heartburn in my experience are longer term contracts where customers provide a deposit, because a deposit, oftentimes in a cash method, that became revenue, that became income when it was received. but maybe the work still needs to be performed. And so if you've got a longer term contract, construction is often that way. So if you're buying or selling a construction company, and your customers giving you 50% down for a custom home, um, then that's a liability to the company, technically under normal methods of accounting. And so the the seller can go, well, I got that cash. That's cash to me. It's not part of the peg. But the buyer is going to say, well, this is a liability. So yes, you got the cash, but I have to go and perform the work as the buyer. And so there's a rub, just because cash in hand is to a seller is going to be worth more than the liability. And you're also assuming as the seller, you're assuming, well, you're not going to run the company as efficiently as I was able to run the company because you're new to this company. And
Sure.
so you're putting more liability on the deferred revenue side than I give you credit for. And so that can become an argument.
So I've seen that as well, and it's good that we're defining this. Is that sometimes the seller they have the deposit. They're saying, "Hey, I'm giving them these deposits. This should be some kind of credit to me. I'm handing over cash." But really, it's just a deposit. No work has been performed. It's actually a liability. They have this cash, but they owe performance. They owe the deposit was given to purchase materials, to secure some maybe labor ahead of time, some administrative overhead associated with, like, let's stay with the construction, but site visits and planning, utility locations, etc., those types of things. I None of that has been done yet. I already have the money. I owe this performance. So really, what you're handing over is, yes, you're giving them the cash, but you're handing over a liability. So understanding which side of the fence, what the assets and what you're transferring falls on. Is it an asset or is it a liability? So defining those in the working capital, and we're getting kind of into maybe the work in progress a little bit, and how that's calculated. Um, but again, we're back to definitions, because there can be just hey, I'm giving you cash, and it's like, no, you're giving me responsibility and liability. Who owes who here?
Yeah, and often that can be negotiated, and there's oftentimes, as you've seen, I'm sure, there's a adjustment period, and so you can say, well, what do we actually realize? What was the actual profitability of the deposit after the work was performed? And so oftentimes, the deal closes, and then 90 days later or something, there's an adjustment where we can reflect back on that closing date and what the true assets and liabilities were, um, and adjust accordingly so that everyone's treated fairly.
So let's talk through that. We said the peg and the kind of the initial agreements are based on assumptions largely, right? We've made assumptions that we believe to be in the range, but we do have a runway and a process for testing those assumptions and make sure that assumptions are ultimately turn into facts. So when does that happen? What is a true up, and how does it work?
Yeah, so much of the deal is built around that working capital peg, which has many assumptions and estimates in it, because the world is moving all the time, and so you come up with that estimated peg. The peg is agreed on. That usually doesn't move. The peg is exactly that. It's how much the buyer assumed needed to be in the tank, and you guys agreed as buyer and seller. It's part of your deal, and that was the peg.
So let's say a purchase price of a service company, of $3 million, and we're saying $400,000 of working capital needs to be included.
Yeah, and so
Right, so something like that, just to put numbers
exactly.
on it. So we've agreed it's going to take us
Yeah, and so
400,000.
let's just say, and we'll just use very keeping with being simple, like, and so if that 400,000 of working capital is receivables and there's no debts that you've assumed, we're just say that there's a receivable on there, you're going to collect 400,000 within whatever certain amount of time at the date, but as of the date of close. So that might be based on some estimate of a number of a list of various customers that owe the company money. Well, possibly, right? One of those receivables came in, and part of a deal typically is that the seller will flush cash. They'll pull all the cash out of the business. And so usually it's like they call it cash free, debt free. And so cash gets
Mhm.
stripped from the business, the day of close or the day before close. And then unbeknownst to anyone, well, before the deal, one of those payments came in. And so one of your distributions was on one of those receivables. So you had 400,000, but one of your customers happened to pay the day of close, and you, as part of that flushing out, you pulled that money out. So you might have pulled out, say, 50,000 that you received in deposits. So now your adjustment, or your when you look at it backwards, and you're like, it's all spelled out in the agreement. It can be 60 days, 30 days, 90 days. It doesn't matter. But when you look at that adjustment, and you go,
That's the true update. That's the time after closing that we agree to revisit these
exactly, you
assumptions.
revisited it, and you went, okay, well, I looked at the receivable, and buyer was supposed to get credit for 400,000. The day before close, 50,000 of it was paid. So the receivable was actually 350,000. You took that 50,000 out of the company at close. So but you
When you
pay us
swept the
back for
cash.
that 50,000 that you stripped, because we were supposed to have that as fuel in the tank to pay our bills. And so that adjustment period happens, and then in this case, right, the seller would pay that back to the buyer. Um, that's very common that can happen. Flip side, you could end up having a sale, like, last half of the month, you had a great month the month before the sale, and what it allows for is the seller to not be motivated by slowing down sales, right? To not go, we're going to slow down collections or whatever, and so it allows a comfort to a buyer to say, continue to operate the business as you always would, and don't accelerate or decelerate bills or payments or collection.
Or
Right.
anything, right? Business
Yep.
as usual, all across on all
Exactly.
fronts.
And so it allows for that ability to be stable and not be hinky with the operations of the company, up leading up to the sale and the closing date.
Because of understanding deal mechanics, and having both sides, act in good faith and as they normally would, without trying to manipulate some of these closing mechanisms that you did mention cash versus accrual, and kind of recognizing revenue, and when things are when money is collected versus when it hits the books. I mean, all of that can really skew numbers depending on how you report it. I mean, talk about the difference in another concept of cash versus accrual, and um, why that's important.
Well, cash versus accrual, in the typically there's if you're a seller, or a small taxpayer, getting away from just selling a business a little bit, there's a simplicity to cash method of accounting, because I'm paying the tax that I would pay as it follows the cash I collect. I deduct the expenses as I pay those expenses. So it's not necessarily based on when I
Uh-huh.
earned the income, it's based on when I collected the income, and it's not based on when I.
So when you get the cash, or when you get the bill, or when you pay it, cash in, you recorded. Cash out, you record it. That's when it
Exactly.
happens.
But it doesn't recognize the receivable, the amounts that I've billed my customer and I'm waiting for payment, because the bill is when I earned it, usually. So
Hmm.
if I'm billing my customer, you know, typically it's when I've earned that revenue. And so,
The job is completed. I've finished everything. You have the project, the deck, the
yep,
house, um, whatever it is, the backyard.
yep, exactly.
That balance is now owed, but
Exactly. And so that's what I can expect to collect. So if I'm an accrual method accounting business, then when I have billed, say, my customer and I've earned the project's done, often, right, as we get from, going to the doctor, or whatever, I get a bill and the bill is going to say you owe us in 30 days. And so if I'm if I'm accrual, when I sent the invoice out, I'm going to recognize that as revenue and I'm going to put a receivable on my books. If I'm a cash method, I don't put a receivable on my books. And when my customer finally pays me within 30 days, hopefully, I collect the cash and then I recognize the income. Same thing. If
Mhm.
I if I get a bill from the utility company and it says you owe us in 30 days, for the utilities that you consumed, last month, um, then I would recognize that as a payable and I would recognize the expense if I'm accrual. If I'm a cash method, then I don't recognize the expense until I pay it. If I'm a buyer, I don't know if I didn't do any checking and I just look at your balance sheet. I don't know what's coming in. I don't know what you've billed. I don't know what to expect in terms.
You won't know about it
Yeah.
until it comes in, right? You don't know that there is this other job essentially that you completed and the revenue is due to come in.
Yep. Yep. Exactly.
Um, when it hits the mailbox, that's when you
Exactly.
know.
And I guess, in one sense, if I'm buying, it can be more simple. Like if I'm depending on the industry, right? If I'm buying a restaurant, the cash collected that day is typically what you received that day. And so cash or accrual, there's probably very little difference. Um in a cash for
And your inventory is essentially your working capital, right? In that setting, in a retail setting, there's probably not a large payable or a large receivable. Um,
exactly.
it's a business model. Um, business model specifics kind of dictate, what accounting methods are appropriate
I think so.
oftentimes.
Yeah, I think so. And if I'm retail, if I'm yeah, restaurant, I what I collect that day is my revenue, and I don't have a lot of receivables on my books. If I'm in construction or if I might have a lot of deposits on my books. And so those, like as we talked about, those are liabilities. I got a bunch of cash, but I have a bunch of liability. And if I'm cash, then maybe I'm not recognizing the liability and I've recognized the income. Um, and so there can be a big difference depending on the industry. Manufacturers are that way. Manufacturers sit on a lot of inventory, raw materials, finished goods, and stuff. And so, you know, is that inventory expensed? Are they supplies that you've expensed? Because if you remember, as you before a sale, typically a seller is going to be motivated by deductions, and so they're going to go, "Well, I bought this
Hmm.
inventory, but because I'm a small business, I can expense my inventory." And so you might not have, as we've talked about, basis in that inventory because you've expensed it already. And so cash and accrual can be significant to a seller in knowing what they're selling and then what the buckets are that you're putting the allocation of the purchase price. It all kind of fits together. That's why I like what I do.
It ties
Yeah, it's a
together.
puzzle.
Yeah. Um, and oftentimes it's accounting standards that sort of dictate how the reporting takes place. So we often see the term gap accounting, and that's another thing that another term that can enter a smaller deal. And then the reality is that up to a certain size, the accounting is it may be QuickBooks, it may be on the up and up, it may be all legal, but it's more in line with how it works best for the owner and for the business and for the customers, and historical practices versus here's the standard of compliance that we all adhere to. What is GAAP accounting, and when does it really enter the equation?
Yeah, GAAP accounting is the terminology used by our industry in general accounting. Trying to simplify it down, you can say it's the
What does it stand
generally
for, just
accepted
first of all?
accounting principles. So it's generally accepted.
Okay.
There's different accounting principles throughout the world. So there's international accounting standards as well. But for us, it's basically the U.S.'s definition of what we've all agreed as an industry are the proper accounting to represent the balance sheet and the income statement. And so it allows for different businesses, no matter what industry, to agree that these are the accounting principles, these are the representative numbers that are accurate. Doesn't matter what industry you're in, that a receivable and a liability, they all have the same sort of definition. Now there's different rules within that, but essentially it puts puts trust and common terminology across businesses, and spans across whatever you're looking at. You can say, okay, I know what that is in my payable. I know what that is in my inventory. Um, there are different standards within.
Is there a size threshold, like for a business that should adhere to GAAP versus
Unfortunately, no.
not?
It's going to be dictated typically by your stakeholders. So usually the investors or the bank are going to require GAAP accounting. Where it comes to light in an acquisition is that's the speak that we all understand and that the lawyers understand and they use. And so typically a seller in a small business, even a medium-sized business, is maybe going to not be generally accepted accounting principles, that GAAP standard. They're going to be something other than that. Cash method of accounting, as we've talked about throughout this conversation, is not GAAP accounting. It's accrual accounting is GAAP accounting. And so,
Okay, that's an important distinction. So GAAP accounting is accrual accounting essentially,
yeah, even and then some, but yes.
and then some on
Yeah,
top of
yeah,
that. Yeah,
exactly. So, um,
but there is no cash GAAP accounting.
there is no cash GAAP accounting. That is correct. Yes, yeah.
Okay.
So that cash accounting comes to light because it's tax motivated. And so and it aligns cash receipts and disbursements with the amount of tax that you're paying at the end of the day. So it it's more streamlined. It's easier to look at a bank reconciliation and go cash in, cash out. That's your accounting, but it's not GAAP, and it's not telling of the future benefit of the assets that somebody's buying or the future obligations of the company in the short term. So buyers are going to look to GAAP accounting, and that's where some of the complexity in the transaction and some of the maybe potential discontent, and we're really being supported by good accountants and good brokers and good lawyers can help to define that and bring a seller up to speed on what the gap is, and then oftentimes will then help set up maybe even a second set of books so that you still are operating cash method, but you do have a good understanding of what your accrual method of accounting is. Because I've not, I mean, it happens, but I've not seen a lot of final deal documents that don't refer back to GAAP accounting. Sometimes they'll say deviations from GAAP and they'll put a list of things where
What's the term?
deviations. So we're going to do
Deviation. Okay, so
we're
based.
going to do GAAP, but we're going to deviate from the standards in these specific accounts.
Got it. But it's important to pick up on, and again, we're kind of going between legal and accounting advisory. But if you're looking at a purchase and sale agreement that says all financial statements will be, GAAP compliant, if they're not, we need to discuss that, and we need to inform, the buyer, that we really don't, that the books are in good shape. We believe them to be accurate, but they're not going to be GAAP compliant. And maybe, if there's a slight difference, maybe we can add in a deviation caveat. But if you're really not running GAAP at all, it's going to be pretty difficult for deal purposes to convert to it, especially historical
Yeah,
books.
it's timely, or it's time consuming, and it can be, if you're doing it in a very short window, it can be pricey, right? To go to professionals, and then getting the buyers accountants to look at the gap accounting, because they don't have comparative financials to go back to, so they're going to do a lot of scrutiny on the gap accounting. So knowing and being prepared earlier, um, then that is helpful.
And this is kind of a next deal term introduction here, and a segue to it, but can a quality of earnings report help? And it's something that has been prevalent in deals as of late, again, permeating down to smaller and smaller deals. But if we can't fully, maybe agree on accounting terminology, if what we're looking at on the books that you've provided has, no pun intended, some gaps, can we do, can we do, an extended report, an investigation of sorts? And what can you say about quality of earning reports, and do they have a place in deals of all
Yes.
sizes?
Yeah, quality of earnings report is even more, they're important, but they're even more important when it's not a gap financial. Um, I think that it's telling and informing the seller and the buyer that you have a well-run operating business with, cash flow history and earnings history, over the last 18 months, over the last 3 years, whatever the span is. But if you're a cash method taxpayer or cash method reporter, quality of earnings report is going to be really helpful, just to know that you're not leaving money on the table. If I'm a seller, I would want to have a quality earnings report, so that I've sort of have done an inspection of my company, and I know that I'm not leaving money on the table, and I'm not demanding more than I should.
So you're saying proactively it can benefit the seller, because typically it's a buy side request. It can make sense for a seller to lead and do a quality of earnings report, maybe in the evaluation stage, and have it ready, just so that they can understand their own inner workings, and like you said, aren't leaving money on the table. Does it make sense to do a proactive quality of earnings reports for the seller, considering selling?
If I was coaching a seller, I would request a quality of earnings report. They're and they can vary in scope and depth, but I would do one if I was selling my practice, my business, um, to have that done. The most successful, least contentious deals that I have worked on, the seller had proactively done a quality earning report.
Hmm. Does it simplify due diligence? I mean, does it cut down on
It's part of due
kind of
diligence,
that?
but a buyer is going to still, I would hope, do an inspection and due diligence. But it does help sort of guide and maybe help in structure, and maybe even help with efficiencies and focus points, um, so that that they're not using a shotgun approach to diligence. But really, just it helps. It helps a broker, I think, know and understand the business a little bit better, to have that quality of earnings report done. And you talk diligence, doing a sell side diligence project can help, know where the cobwebs are so you can kind of clean them up. All of those things, whatever you can do to prepare from a seller's perspective before you know, put a business up on, to the market, I think is incredibly helpful. I look at, if I sell my house, I might take a look around. You know, if I don't look underneath, in the crawl space, like I don't know what's underneath there. And so doing all of these inspections really helps me be informed of the things that I may not know and the thing, good and bad. But it really helps sort of clean things up and put some curb appeal to the business.
Yeah, we do an extensive business evaluation certainly prior to listing the business, but prior to even signing a listing agreement or asking for a listing agreement or any kind of financial or contractual commitment, simply because we want to understand what the business is worth. We want to understand the areas of improvement, what's driving the value positively or negatively, what we can get ahead of. Because if we can get ahead of the issues and fix them before we list, we're assuming that the marketplace and the buyer will pick up on through diligence or quality of earnings or any of these other investigative procedures. It's a lot easier to either be aware of the issue, if it's not fixable, or be aware of it and fix it to the extent possible. Again, ahead of time. Back to planning and preparation.
Can I ask you a question on that point? And it's
Yeah,
little
absolutely.
off topic, but in terms of setting up from it's all about, especially on the broker side, I would imagine it's all about how do we find value to the seller and
Mm-hmm.
opportunities to increase value. And so I can imagine sell side diligence would help and quality of earnings report would help. Where in the point of the process do you look at the multiple and how do you figure out something like a multiple? And I know that's not tax and talking structure,
Mm-hmm.
but I'm curious about the
Yeah.
multiple and how that comes into play.
Yeah, so the multiple is essentially a risk adjusted rate of return. So, what is the appropriate rate of return for this particular, well, in a larger lens, asset class? What's the asset class? Privately owned company. What are the risk factors? A single location retail business is different than a large manufacturing company with a distribution network and sort of um, a more predictable revenue cycle. We're looking at longevity. We're looking at historical recent performance. We're certainly looking at businesses, in the same industry and in recent comparative sales. But if you're looking at industries, for instance, hospitality after COVID is viewed as riskier than let's say manufacturing or home and commercial services, right? And in COVID, HVAC and home services businesses took off. Retail restaurants, for the most part, suffered. Right, so people were willing to pay barely any multiple for a single location restaurant, and maybe you've seen them, but these absurd, astronomical 7, 10, 12x um, multiples for HVAC businesses, right? Because one was viewed as very risky, and one was and so and one was essentially viewed as recurring revenue and risk free. So um it's back to a risk adjusted rate of return. So 2x is a 50% return. 3x is a 33% return. For multiple, right, we're expecting a 25% ROI, 5, 20%, and so on. And you can take that all the way down to commercial real estate, which, let's say, um, a warehouse property in Seattle or Pierce King in Snohomish County can transact at a 5% cap. Well, what does that mean? That means that a buyer is willing to wait 20 years, right, essentially to get their money back. So that's a
Yeah.
20x multiple. Why? Because viewed as very low risk. It's essentially a government bond, right? At that, at that point. And um, so that's how multiples oftentimes are determined. I mean, if we're, let's say risk in a retail setting, we can look at, if it's a franchised opportunity, right? Let's say a well-known franchise that's doing well, and it's 4 or 5 locations. Maybe some of them are doing a little better, some are doing a little worse. You're still risk diversified. That would command a higher multiple than a single location restaurant. Car washes that involve a essential service, and then real estate, much higher multiple. So it's more on those kind of merits that they're determined, is how quickly does the buyer want to get their money back, and how quickly they want to get their money back is determined by how risky it is, and how scared buyers are of that industry. So that's
How do you, I'm curious, how do you coach a seller
yeah.
where they're in an industry where it's their personal reputation, what we call personal goodwill, and they're figuring
Personal
out the
goodwill.
value of what they're trying to sell, but then you're realizing that as they're trying to get out of an industry, if they're like a doctor's practice and they might have multiple doctors that are maybe in their practice, but everyone's going to see them. And so if people get out,
Yeah. So that's a risk
yeah,
factor, right? That is a big transition risk factor, and you get into this, what at this point is kind of a trendy word that's trending, is owner dependence, right? You get the owner dependence, and owner dependence, is how much is this an independent business, and how much of this is dependent on the owner when they leave, what's left. That increases the risk of transition tremendously, and it decreases the multiple, because and it creates all kinds of hedging mechanisms in deals, with holdbacks, and tied to customer attrition rates, with clawback, provisions, with seller financing, long transition periods, long horizon exits, 3 years, kind of 3-year transition periods and more sometimes, where the seller stays on and essentially stewards this business to a place where the buyer now feels safe, and the owner can be gently sort of removed from that environment without any damage to the business. But it's a problem. It's a problem because the owner is the bottleneck, and essentially, in the worst cases, without the owner, there is no business, no matter how profitable. If you're a movie star, if you're George Clooney, can you sell your movie star career? No, because you are the
yeah.
product. So if you run, a franchise of Chick-fil-A's or 7-Elevens, I dare any buyer to name the owner of a fast food restaurant that they frequent, or how many there are, or who owns the gas station or a convenience store, or whatever. But there's degrees to it, right? Then you go to the neighborhood restaurant, super popular, and people go, yeah, I know the owner. I go in there on my birthday, and he plays the piano, and I take my family in there. That's important, right? All of a sudden, would they not go completely if he wasn't there? Probably not. Maybe some people wouldn't go, but then you get into those degrees of, yes, people know who the owner is, but they still go there because the food is good and the environment's
Mhm.
great and they like the price point, and sort of all those normal considerations. So you have to look at the transferable economic benefit, risk adjusted transferable economic benefit, right? Can I transition this to somebody else? And we evaluate risk in our evaluation models and say, this is going to be high risk, this is going to be low risk, and the higher the risk, the lower the multiple. That's really the
So I can imagine then that in that industry, in the professional services sort of high amount of owner involvement, um, you're being involved on a possible future sale earlier than not, so you can help coach them sort of to help replace themselves earlier would be ideal.
Yeah. I mean, 100%. And there's some things I mentioned, I think briefly, that there's some things that aren't fixable. Like if you just had a terrible year in, 2025 or it's going to take a few years to leave that tax return in the rear view. There's nothing we can do. We need to own it. We need to put context around it and say, this was a difficult year. This is kind of the nature of this business model. It has ups and downs, and this was a difficult year. Right? There's not much we can do in, let's say, project-based construction businesses, right? They have ups and downs. They're tied to interest rates. They're tied to the housing market. They're, all of those things that if building stops, their business goes up and down. But things like owner dependence, it that is a factor that very often can be fixed through leadership development, through the owner recognizing that they're a bottleneck, because it can be a point of pride. Hey, when they run it, I am the business. Without me, this business doesn't run. Now, play the tape forward for a buyer. There's no worse thing to hear. Like, as good as much of an ego stroke as it is for you when you run the business and you're the face of it, it's it, it's it hurts the sale prospects. So maybe there are people in the company that need to be given some agency. Maybe the owner actively needs to start separating themselves from the business. Oftentimes it's things like protocols and procedures. When the I'll call it the market, but individual buyers, when they look at a business, they'll say, well, how do you do this? How do you hire? What is your onboarding procedure like? What software do you use for estimating? What's your client outreach? What's marketing like? What's the company culture like? How do we communicate with staff throughout, the workday? And if there aren't those systems and it all lives, as they say, in the owner's head, you can spend, 12 to 18 months and kind of start writing it down, start making manuals, start putting in processes and procedures and protocols and testing them. Here's this new manual. You don't need to call me every time a customer asks this. Here are our responses. I'm just giving kind of examples of building a book. But that makes it transferable. If it lives in the owner's head and he or she is approving, how many decisions do you have to make every day for the business to run? The closer that number is to zero, the better. So you kind of need to work backwards. But that is very, very fixable, provided the owner understands the value of it and is willing to do the work.
Well said. Yeah.
Yeah. Good detour. No, I like it. I mean, is that something that you kind of encounter with clients? And
Yeah, well, I often I've been curious when I'm working with a broker, is like, how do they set the price? And I understand multiple and I understand, but I never have understood how to set it and what you're looking at, and does it help? Because when we're looking at it as an accountant, we're looking at what are the adjustments that are made to before the multiple, things like getting you know uh, getting personally used assets out of the business, stuff that can happen prior to the sale, so that a buyer is going, okay, these are the business assets I'm buying, and it's not commingled with the home office. It's not commingled with company car that buyer put in, that they just wanted the depreciation write off to reduce taxes and things like that. So looking at things like underpayment or overpayment of wages to ownership, family members that don't really do a ton, but they're getting compensated. We're looking at those things, right? And we're going, yeah, we can earmark and help work with the broker and help work with the owner to clean up the P&L and clean up the balance sheet, But then at the end of the day, whatever that adjusted number is, going, okay, you think about, like, if you're paying a nephew $100,000 and they're just coming in part time and not doing a lot, well, if I can take their pay off the books or adjust for it, and the multiple's 5x, well, that's $500,000 of adjusted value. So recognizing where those
Yeah.
things are is key, and working alongside the broker to know what the multiple might be, and then we can communicate back to the seller to say, look, it's going to be worth it 5x this number to clean that portion up. Nephew might not like
Uh-huh.
to hear that, but
They may not like it. Yeah, but we have a document called the adjusted cash flow statement, which in essence makes those adjustments and recasts some of those assumptions. And in the evaluation models, one of the things we adjust for is not what the owner pays them or pays family members, but what is the true replacement cost of that ownership? That's what we factor out of the multiple, essentially, or out of the revenue, the profitability number, the multiplied. There's the multiple and the multiplier. So we're multiplying a number times revenue, essentially, or profitability. So before we can do that, the multiple is not applied to the job portion of the business. So if I'm working and my labor is worth $100,000 as an owner, a buyer doesn't want to pay 3x for the work that they have to do. They will pay 3x for the additional 400,000 of owner benefit that it generates, but we're going to factor out their fair market labor cost. So we're not taking straight profitability and saying, okay, this business is making 700,000 a year. We're going to say it's a 4 multiple, just round numbers. The business is worth 2.8. What if there are 4 owners and they're all working full time? That's a different 700,000 than somebody managing the business executively remotely and the business running itself, right? That labor contribution of ownership is very different. So we have to look at the principles, who is doing what, not only what the business is generating, but what is the owner doing for that? Because again, their labor, they either have to work in it or they have to pay somebody to do their work. Either way, that's factored. That's not, nobody's going to pay a multiple for that portion. And so with some of the smaller businesses, I mean, they're buy a job businesses. An owner may be making $200,000, but they're working out 80 hours a week. There is no multiple or very little, because there's no money that the business is generating beyond the labor contribution of ownership. It's a job. So we have to look at all those things, and that's part of what we dig into in the evaluation is, who are the owners? What do they do? What does your weekday, month look like in the business?
yeah,
Mr. Owner. And sometimes, they don't think about it. It's, oh, I don't work at all, except, I'll do the books real quick on Tuesday, and I'll go to this meeting on Wednesday, and I'll meet with the accountant on Thursday. But they're not thinking of that as work. But in the process of sale, we have to look at it as, that's probably one full-time equivalent of, a qualified, somebody who has an office management skill set, right? How much is that worth in wherever the business is located? In King County, it's probably 80,000, 90,000, 100,000, depending. And then so it's not what the owner pays for them. Same thing with, for instance, like if they own the real estate and it's seller occupied real estate and they pay rent, right? They have a landholding entity and an operating company, and one pays the other rent. Oftentimes they'll just assign a rent number, right? And they'll say, well, here's what I'm paying. Is it fair market rent? Right? Because a business has to pay fair market rent. We have to adjust for it, because whether they're selling the real estate or they're staying on as the landlord, if they're 50% below market, the conversation with the owner is, are you willing to lease it at an arm's length lease to a buyer at 50% below market? Do you want to own a real estate asset that's 50% below market? Well, no, I don't. Okay, well, then we have to increase the rent. Guess what? That's going to reduce the profitability because you were operating at an artificially low occupancy cost, right? So we have to make that adjustment. So the same thing with what they're paying themselves. It almost doesn't, I mean, typically they're close, but the IRS kind of wants it to be reasonable, but sometimes it'll be way over. They're not working in the business and collecting, $250,000, or they're working in it and taking nothing.
Yeah,
So
it happens quite often. There's, yeah,
yeah,
they're trying to save on whatever it might be motivation wise, right? They're trying to save on payroll taxes, so they pay themselves below market wages, or they're trying to be cash flow neutral they own the building on a separate company and they're paying themselves rent, as you said, but they're just like, we're just going to be cash flow neutral. So the building might have a mortgage on it and some property taxes, and they'll look, oh, we're triple net. So the business pays all of the expenses and we're just cash flow neutral. Um,
and all of this may be the result of a well-meaning accountant 20 years ago, right? And they haven't revisited since then. Laws have changed, and there's all kinds of things that could and need to be adjusted. So we're adjusting for today, and under with the understanding that the buyer is looking at it. They're very happy that the business has been great to the seller. Historical sort of financials look great, but what are they buying, right? What's the business of the future? Which you get into things like, where in the cycle is the owner selling? They very often they'll decide to sell when um, you know maybe the business isn't going well, maybe performance is down, maybe they're kind of at the trough of the cycle, maybe an employee left. And they're going, this is the time to retire. I'm done. Well, that's when it's least attractive, right? And that we can't we can talk about the glory days and that they're coming back, but that's not what the documents are showing now. What they're showing now is the closest representation of what the buyer understandably and fairly assumes that they're buying. They're buying, what's happening now. That's the closest sort of data set to an indication to
yeah,
what it will
I
be.
found that sometimes sellers wait a little too long to get out, and they're burned out and they're older and they want to be 1 foot out the door and retired and go to see grandkids and live their lives. And they sort of waited too long, and so they continue to be there, but they're reducing value by being
Yeah.
like get on top.
Well, you get the best time to sell, and this is the most difficult thing to do, but you got to sell when things are going well
Yes.
and getting better, right? Because that's when it's most attractive to whoever's coming in. And then the logical argument to that is, why would I sell? I'm well staffed, things are going great, I'm making money, I'm not. You wait, and then it will cycle back, and then things aren't as rosy, and you go, you know what? Throw down
Or
your pen. I'm done. I
yeah,
just
naturally,
sell,
right?
right?
You're
But it's
selling and you're frustrated. Business isn't going as well as it used to be. You become a little more burned out, a little more upset and jaded about it. And so you waited too long. Yeah.
yeah, yeah. So yeah, I mean, we deal with some of the same, certainly some of the same dynamics, and I'm empathetic. I completely understand. I've been a business owner, and I've sold a business. Um, but I try to counsel from a position of knowledge and experience, and say this is really counterintuitive, but you need to plan in advance. And the most important metric for valuation is not what the market is doing. It's not what the interest rates are doing. It's what your business is doing right now, right? What is recent and current financials, and not just financials, operational stability, employees, all of those things. Um, is You need to sell when those things are kind of like a jet airplane. You're on the runway, you're about to take off and start gaining altitude. That's when it's
I
exciting.
can imagine.
You
So
know?
curious.
Yeah.
So we talked a lot about, like, people have different roles in, as your client comes to you, business owner comes to you, and they're ready to sell. And usually they're going to have an accountant. They're going to have, maybe they don't even have a lawyer at that point. But think,
Oftentimes they don't, at least not a transactional lawyer. No, not a
so when do
business attorney.
you say, hey, this is a team approach? We need to build your bench. Because I look at it as like we all have our own sort of expertise in our professions, and not like and not all accountants are transactional accountants, not all lawyers specialize, right?
100%.
Lawyers are like,
Yeah.
we're your intellectual property lawyer, we're your property lawyer, we're your, real estate or employment, transactions might not be what they do. So as you're building your expectation with the client, but then building the bench, at what point do you educate the seller saying, hey, okay, we need to start connecting the dots with the right professionals and the right expertise? And then is it a hard conversation then to say, your accountant sounds like, maybe you just ask, is your accountant a transactional accountant? Are they just a tax preparer? Do they do your books, or do you do it them yourselves or internally? How does that work? Or
Yeah. No, great question. And certainly, my approach is time and team are the two most important things. So give yourself time, prepare, and build a team. So I, like you mentioned in the beginning of the conversation, as early as possible, strategically, um, the because oftentimes we don't have a long-standing some relationship with the seller, and we may be referred by a wealth advisor or another professional advisor. So I don't come in with my own team recommendations, but once I complete the evaluation, which at that point, we've spent some time together. I've requested, the evaluation is based on a thorough document set, and so once I've learned about the business and we've reviewed the evaluation with the seller, there's usually a time period where they absorb kind of the findings and the recommendations. And sometimes it could be around price, it could be around timeline, it could be around their timeline, any number of things. I often recommend that they run the evaluation by their CPA, or ask them if they have a CPA, who kind of what their relationship is, if they're just doing the taxes or their actual advisor. Um, and then I say, run the evaluation by your attorney, by your CPA, by your financial planner, and see what questions they have. I'm available to answer any questions. If there's anything here that wasn't clear, because the evaluation is a substantive document, and it can take some time and kind of knowledge to really fully understand everything that's in there. And also at that same time point, I'll have the conversation of, this is I've given you a price range for what the business will likely transition for in the next 3 to 12 months. These aren't your proceeds. There are factors here that can really impact how much money you walk away with. I don't know your overall financial plan. I don't know the rest of your tax situation. I don't necessarily know what your long-term goals are, right? Are there things here that we should be planning for? Is there a 1031? Should we be earmarking proceeds for tax deferral, for future investments, et cetera? And I'll be very transparent that isn't my area of expertise, and that there are accountants and CPAs who I can introduce. So at that point, usually at the evaluation stage, I will either make a recommendation for a CPA, or at least recommend that they talk to a CPA who is well versed in deal dynamics and sort of transactional issues.
that makes sense.
Yeah, yeah. And so and one of the recent transactions I did, I mean, came from a wealth advisor, and then went, through an attorney, a CPA. We completed the sale and went back to the wealth advisor for reinvestment. So that's kind of the full
But
cycle. Yeah.
yeah,
And then we knew that from the start. And just like you said, you had these perfect case studies. That would be my perfect transaction to where, and I didn't recommend the CPA on that. They already had it, but I recommended the attorney.
yeah,
And we typically recommend, you know, several different professionals so that they can, have a choice, and then people kind of connect differently. And sometimes, uh, you know, it's important that people are communicating well. So they talk to a couple different people and say, yes, this is good. We're going to work with Chris, or,
yeah,
so, but no, I'm a big fan of team building and working with the team. And I think and I've seen this in deals, is the biggest surprises is the, understanding the taxation, and so, understanding the net proceeds when they look at the evaluation, and understanding them ahead of time versus when we're when we're, in the middle of a transaction, and we're looking at tax allocation, and they're looking at tax rates and how things will be taxed. And it's like, wait a minute, I'm paying how much in taxes? Let's talk about it now. Let's talk about whether this is better an asset sale or a stock sale. Let's talk about how we position this in the marketplace so that we're setting expectations, oftentimes in the listing phase. Working capital, right? Another great item to wrap your head around ahead of time is, um, you know, let's not wait until the buyer proposes it. Let's understand what it is ahead of time and what we should be including. So, long and winded answer, but I try to bring in the CPA as early as possible.
yeah, yeah. It makes sense.
Yeah. You got a few more minutes?
Couple, yeah.
Yeah, couple. All right. Quick question. So what, when deals become contentious, it's buyer and seller start out on the same page. They both, buyer wants to buyer wants to buy, seller wants to sell. They have a common goal. Why do deals go off the rails? Where do you see, what are, a couple bullets that where you see friction in deals?
Friction is more, often it's a seller has an expectation of a certain amount, or that a deal's going to run, a certain way or be in a certain timeline. And so when those things are not met, you know, sellers can get frustrated, because they've got an expectation in mind, whether that's money or timing, or both. And so it can go, off the rails that way. And seller and buyers want to have guardrails. They don't know the business, they don't know its history. They might know the industry, but they don't necessarily know that business, and so they want to have guardrails around it. And sellers, of
Mm.
course, always feel like their business is worth more than maybe it is, because it is their baby. So um, they're looking
So,
at it at that end. Just got to reset expectations, realign what's important to the seller, kind of coach them a little bit. But I tend to go, I can provide the numbers and I can be that counselor if needed. But you rely on the team and you rely on sort of your own soft skills to reevaluate or help coach, and then realize if you're not going to get there, where's the line? Where what's important? Where's the line in the sand that you're not willing to cross? And then let a seller know that it's never too late to just say, you know what, this isn't your deal, even all the way
mhm,
up until close. But you never want that to happen. But it can.
yeah, kind of like, you don't have to do this, right? If you don't want to. But yeah, hey, money, time, and emotions, is what I heard, and oftentimes those are the ones that, in their large categories, but they can really send things off the rails.
Yeah, well, it's setting good expectations, having
Yeah.
good communication, knowing, letting your seller, letting your client know ahead of time that yes, here's your deal, and we've put this together. I'm going to put myself in the buyer's shoes, and here are the points that they may have issue with. And so we'll talk about it. We'll put guardrails around it, and, you know, and then we'll see where it takes us. Sometimes they never even bring it up, but, often, sometimes they do, but at least you're prepared.
How important is having the right evaluation for a business from the start? I mean, having the right jumping off point.
Yeah, it's so key to setting good expectations. You don't want to set an expectation that's wrong, and then you got to go back and reel it in. If you say the business is, we think that you're going to get, 8 to 10 million, and then the buyer comes in and says, I'll give you 4,
Mm-hmm.
you know,
Yeah. Yeah. That, you know, that, that can create some friction in the middle of the deal. That sh- should have been discussed before, right? Um,
yeah.
uh, what would you say is one thing every owner should do today, tomorrow, in the next couple weeks? What should they get started on from an accounting standpoint if they're selling in the near future?
I would just say evaluate what it is that they want to do next, and then have a plan to get them there. So, if that's retire, if that's transition the company to, one of their kids, to a family member, to a friend, to a coworker. Maybe they have a great operations manager, and the operations manager wants the business someday. Start doing that now. Evaluate what is your exit. We're not here to, live to work, right? So let's not do that. Let's actually look at and evaluate, what do we want to do? You know, what do I want to do when I grow up?
Mm-hmm.
And plan for that. And so it's just maybe having that internal discussion, and having that discussion with family, with spouses, and family, to say, yeah, we're doing this now, but what's next for me, and how do I build a road to that, um, so that it's organized and I'm prepared.
Mm-hmm.
And that, owning a business or not owning a business. I mean, if I'm a
Yeah.
manager at Starbucks, like, what am I doing next, and how do I get myself there?
Yeah. It's just general best practice, right? Just plan a little, you know.
Yeah.
Any resources that you're a fan of? I mean, this could be websites, books, podcasts, shows, anything, your articles.
Yeah, there's a lot, right? Art of the Deal, and there's a lot of books out there that are great. There's AICP has some valuation resources. There's a lot of IRS sources. Your source, can be your team. So if you have business owner has accounting, like accounting team, tax preparer, advisor, connect with them and say, hey, here's what I'm, there are your resource. So, and you trust them, I would hope. So, reach out and just say, this is what I'm planning for. And so, do you have resources for me, to get comfortable with? Ask for, we all have a great network. You have a great network of accountants, of, legal teams, that, and you might say, oh, I recognize that this is your personality as an owner, and, everyone's different. And so being able to sort of help navigate and filter your network to your clients so that they have the right team for them, letting a business owner use their resources that they know and have. And so their CPA is going to be a resource to say, for me personally, I work with a ton of business advisors, brokerage firms, including IBA, right? And financial planners, estate attorneys,
Mm-hmm.
banker, tons of relationship manager bankers, and wealth advisors through Morgan Stanley and Merrill Lynch, and Hoheimer Wealth Advisors that you guys work with quite a bit. I just there's just a ton of really great resources, and there's a ton of really not great resources. And so help you and your team that you do trust to say, I'm looking to sell the business. Who do I need in place that can help me get there? There's certainly books. Built to Sell is a great book. Finish Big is a great book. In terms of are the deal. Like there's some great books out there that people can read. They just have to Google it or whatever.
Yeah.
You'll find
Yeah.
research books and stuff. But I do like Built to Sell. That's John Harwell, I think, or Harlow.
Okay.
That,
We'll make note.
Finished Big is a good book. It's
I mean, stuff that's operating with the end in mind, right? I mean, that's sort of the overarching theme to a lot of successful exit strategies is they're not accidental.
well, we're all headed somewhere. Don't make that somewhere be an accident.
Okay, well put. Well put. Um, what do you want people to know about Evergreen Accounting? Where can they find you? Who's your client? Are you accepting new clients?
Yeah, I'm accepting new clients. I'm at ever-greenaccounting.com, physically located south of Everett, north of Seattle, in Mill Creek, Washington. And I try to be approachable. In terms of how I serve clients, at this firm, knowledgeable, approachable, responsive. I'm not one of those accountants that you email, and then 2 weeks later you'll get a response
Yeah,
that.
accountants. I mean, I gotta say, I know many. I know many great ones, but notoriously unreachable sometimes, especially around tax times. I mean, it's not my gripe, but that's what clients will say is, "Hey, I can't reach them."
Or I
Yeah,
only can get them once a year and then they take the summer off or whatever.
right.
Yeah, no, you're not wrong. We've built a reputation of not really being that responsive, which is unfortunate. There's factors I think to that. Um, there's not a lot of there's less and less going into accounting. Now I think that there's been a turning of the industry, but a lot of the students that were fulfilled by accounting and puzzling and everything, a lot of them went into computer programming and computer science.
Hmm. Yeah.
AI has caused a shift in opportunity in that job market to not feel as valuable or as straightforward as it used to feel in the recent past. And so I think people are coming back to accounting. We've gotten a bad reputation of work-life balance issues and stuff, which has been pretty deserved, I think, in some of our bigger firms. And so I have taken an approach that I embrace technology, I embrace automation and AI, not because I want to do things um, through AI, for example, or automated ways, but really to say, how do we become efficient so that I can focus on what's important, and that's serving clients and answering questions and being responsive so that when a client emails me a question or calls me, I pick up the phone and I'll get back to them, by hopefully by the end of that day at the latest, if not by the end of the next day.
I
Um,
You've been incredibly responsive with me. I certainly appreciate your service oriented approach to your practice because I think a lot of times, when people have an accounting question, not all of them, but oftentimes it feels like a medical emergency. I just realized I'm going to pay, an extra six figures in taxes, right? People want to they want some answers. And at any rate, I mean,
well, they're thinking
it
about it
can
that
be a
moment.
long time to wait for a response.
So there's one aspect, right, where a client is thinking about it in that moment. And so if you get back to them a week later, A, it may not be relevant, but B, they might not even remember why they asked the question. And so getting back
Yeah.
to them right away is helpful. Like getting back to them a couple weeks later, it might not even be a relevant answer any longer, or they had to go somewhere else to find the answer. But you know, it's meaningful. It is helpful if a question comes across, if they say, hey, you don't have to get back to me, today, but sometime next week, if you could just touch base or whatever. I'm thinking about this for next year. Stuff like that is helpful, just because I do treat all questions kind of like they're a medical emergency. And really it's because I'm putting myself in my client's shoes and saying if it's important enough for them to reach out and ask, then it should be important enough for me to get back to them.
I think it comes down to the definition of what is a professional advisor, and that is expressed through sort of how you approach your practice and treat clients. And I mean, I like your definition of it. That's certainly what I would want from a professional advisor, whether it's a CPA, an attorney, or a wealth advisor, or a lender, or insurance. Right? I look for that same quality of responsiveness and professionalism, and which is why I think that AI will not make it obsolete. I don't know your take on it, but
Well, and it'll help us be efficient. It'll help me, in my case, right? It helps answer a question in more depth, and then I can filter the question for its accuracy. I can filter it for its relevance and for just having that real person feel to, to the answer. But it does help, um, be current in a lot of ways. There's a lot of questions that have come out with the big beautiful bill last year and all of the tax rule changes. It's helped with Washington millionaires tax and all of that conversation to synthesize all of the noise that is out there and all the fake news and stuff around different things. And so it's helped me be efficient again, so that I can be relevant and quicker in response to clients that have real questions and don't have the depth of knowledge, and they're relying on their professionals, whether it's myself or their financial planner or their lawyer. We all know what bad customer service looks like, and so I don't want to be that. And
yeah, yeah.
so
And sometimes it's just being available. I mean, you mentioned information. You read, 7 different things about the same law or bill in different sources. Is it real? Is it fake? Just being able to call and say, "Hey, Chris, I read about something that supporters call the millionaire's tax. Is it true? Is it? Yeah, starting 2027, you're probably going to pay an extra 10% in Washington State and capital gains, right?
yeah, well, and the big one is, should I move? Right?
Yeah,
I mean, I'm
yeah.
heading to Tennessee, right? I mean, I get Tennessee. I'm heading to Texas. I'm getting that quite a bit. I'm headed to Florida.
Uh,
No one says Nevada, which I'm surprised by, but you know,
you're sticking around though.
I'm
Are you,
sticking
are you
around.
taking your own advice, or are you sticking around?
No, I'm sticking around, and I've only had one client in dozens of conversations about residency. I've only had one client where it made sense for them to strive to change residency, and it was the first time here in the last 12 months. It was the first time ever that I had recommended changing the residency to California. They
Mhm.
already owned a house there. They're a Washington resident, but it was the
I
only
remember
time.
we talked about it. Yeah, no, that scenario made sense, but again,
Yeah,
you'd have to understand it pretty deeply to be able to make a recommendation. That's part of connecting with clients and saying, it's kind of like our question. Oftentimes, you know, what's my multiple? How's the market right now? Should I sell? There is no short answer, right? We kind of have to sit down and have a few chats, and then
yeah,
look at some documents and really give it some time, and give it the time and effort that it deserves.
yeah, yeah.
Awesome. Well, hey, it's been a great conversation. I appreciate you joining. I know we opened up some cans of worms and touched on a lot of important topics. I hope the listeners will reach out to you for expanded answers on what caught their ear. And like I said, there's a lot there. Your wealth of knowledge. And thanks for coming on.
You're very welcome. It was nice, nice conversation.
Yeah,
My
I'm gonna.
first podcast. I don't know, like this is different. This is cool.
What? Yeah, no, it's laid back. So I'm gonna it's laid back, but no less informative because of it. That's how I like to look at it.
Very cool.
We're gonna stop recording. Hang out for just a minute after this, so we can kind of wrap up some housekeeping.
Will do.